This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
We now continue with Statism, Part 2, with Charles Hugh Smith, now in session.
So kind of speaking to that very topic of how once government gets large enough and has concentrated power in you mentioned, socialist countries, and, in many ways, the United States is a socialist country.
Make no doubt about that. We are now a socialist country.
Yeah, the government controls most of the economy, and it either directly or influences. And so one of the dynamics here that I want to focus on is that when you concentrate so much power in the central state, then that becomes an attractor to anybody that wants to buy that influence for their own self-interest. And so we understand this commonsensically, but it's worth going through this, that if the government has such tremendous power over the economy and the market, then we as management of a large corporation, well, if we spend $10 million on lobbying and campaign contributions, we can get the government to arrange things so our profit is now larger and our risk is lower. Now, if we tried to go and create a competitive advantage in the open market, that $10 million would be a drop in the bucket in a $15 trillion economy. So we'd have to spend a lot more money, and we'd be putting that capital at risk, because maybe after all of our investment in R&D and marketing, maybe we wouldn't get a payoff after all. Maybe we'd actually lose money. But if we get the government to guarantee our profits and lower our risk by eliminating our competitors, well, that's a lot better deal. And so, but if it only can happen if the power of the central state has become so concentrated that they control so much. If the government is smaller and is only there to level the playing field, then no one can go in and buy that competitive advantage from the government. And so that's where you cannot concentrate power in a central state and not get crony capitalism. That's my point.
And exactly right. We did a whole show that really lays out, for the listeners that haven't heard it, lays out exactly how that dynamic works, because crony capitalism is about reducing risk. And therefore, once this begins, can't feed off the government, then you've got to go out and you've got to create wealth the old-fashioned way. You got to go earn it. And you have to take risk to do it. And it's inherently in the human species to avoid risk wherever possible. So it makes good business sense to fish where the fish are. And right now it's in government.
Yeah. And what happens, as you know, Gordon, is the average person with a sense of entitlement goes, gosh, if only we could get rid of these crony capitalists and have a super powerful central state that served my needs, everything would be fine. But that's asking for gravity to be to disappear, or it's a rule of nature that when you concentrate power, then you're going to have crony capitalism, and passing like 1,000-page bills in Congress and writing 30,000 pages of regulations about healthcare or the financial system, all of that just feeds the central state crony capitalism partnership. All that does is build more moats around their power. It doesn't solve anything.
What happens is the complexity goes up exponentially, and at the same time you're trying to serve and keep a larger society which is very heterogeneous, and so you get tremendous amount of polarization. So therefore what happens is you can't get agreements. So you get stagnation. Don't we see that kind of in Washington right now? Call it gridlock, because of these factions that get so deeply entrenched, and there are so many of them that you can't kind of tie it all together to get consensus. That offset with the complexities of what you're trying to do is just a dream of crony capitalism to operate in.
Yes, well said.
In a few years, Charles, the MBA schools, Harvard B School, there'll be courses on this of how to create strategies and how to harness your government programs properly. And it'll be a 2-semester course. It's coming.
Yeah. And that is, as you say, that's the pathway to gridlock, stagnation, and economic decline, because that's the precise opposite of creating opportunity, innovation, and ensuring we have a level playing field. This slide's very straightforward. It just shows that the U.S. GDP, and this is measured in nominal terms here, meaning that it's not adjusted for inflation. So this is the numbers. And of course, adjusted, it would be a lot different chart, but we'll just keep it apples to apples and take the nominal numbers from the Federal Reserve's St. Louis Fed chart here. So there's the GDP. You can see a little tiny dip there at the top of the 2008-9 recession. And so the next slide is of government spending. And we can see here that it's tracked a very similar growth pattern. And so you'd say, well, on the surface, it looks like government's growing no more than the economy itself, and so everything should be hunky-dory. Well, then we go to the third slide, which correlates federal expenditures and gross domestic product. And here we see that by correlating these two numbers, we now see that, government share of GDP is on an inexorable climb since the 50s. In other words, the government's growing faster. Its expenditures are growing faster than the underlying economy. And we can see what's of interest is there was a brief period here in the mid-1990s through the mid-2000s where the economy grew faster than the government. But my point here is those were two one-time events that happened to be back-to-back. The internet and the web boom was not just a stock market bubble. It was, in fact, a tremendous expansion of innovation and productivity. And the economy grew for real reasons. It revolutionized the entire global economy. And of course, the U.S. was the primary generator of the web innovations. Then, when that started slowing down, then thanks to the federal government and Federal Reserve's intervention in the credit and housing markets, then a gigantic credit and housing bubble was blown, and that created a false sort of artificial stimulus. And that was the building of McMansions in the middle of nowhere, the building of malls in the middle of nowhere, and massive expansion of credit. And then when that bubble popped, then we see that the federal spending and federal share of the GDP shot back up to this trend line. And that's a problem because the government is not generating innovation and opportunity. It's taking money out of the private economy and malinvesting it in either entitlements that are unaffordable or bridges to nowhere or generating profits for crony capitalism through the health care bills and a myriad other expenditures. So,
Charles, this chart is even worse than it would look. And I say that for many points, but the one I would make is that the government expenditures on the top of this, on the numerator, that money then is spent as part of the denominator because government, G, is part of that GDP on the bottom. So it goes out, but it also goes out double counted because not only does the government spend the money and it's got government transfer, that money on transfer payments then spent as part of consumption, because the consumer buys it. So it doubles up on the bottom of this. It's one of the flaws in the GDP formula, or the whole process of using GDP. So it goes on the bottom side of it. So that denominator is getting larger and larger compared to the numerator, but the chart's going up, which tells you the degree of which the government expending is actually going. It's actually going not linearly, it's going exponentially here. And it's a distortion that Washington's not going to tell you about.
That's an excellent point.
The old mathematics in me looking at this stuff and saying, I don't like this chart. But anyway, I like the chart, Charles. I don't like the message that you could fall into.
Right. This chart shows the federal debt held by the public, which is the bureaucratic term for external debt. In other words, this isn't debt that the government's borrowed from Social Security Trust Fund and all that stuff. This is actual bonds held by somebody, either foreign investors, foreign governments, U.S. citizens, whomever. And we can see that, as I discussed in the first slide, the government from the 2008 recession has become incredibly dependent on borrowed money. You can see that it's just this straight line up where the federal expenditures are now 40% borrowed money, and there's no trend reversal here in sight. That line is straight up, and it hasn't modified even though the recession is supposedly over. You'll see the line continues straight on from 2009 to the present, and there is no break in that trend, and there's no reason for that trend to snap, except, as you said, Gordon, that when the one-way ratchet goes up, then we have government insolvency and renunciation of debt or hyperinflation, a catastrophic end to this kind of reliance on debt.
Well, as we zoom into the election period, everybody's concerned about the financial cliff, right? That's just beyond it, where we're going to cut back theoretically on our budgets, and therefore the reductions is going to put a tremendous fiscal drag on the economy. And everybody's talking about this massive concern. So the moment we decide we're going to have to slow expenditures, because they're clearly totally out of control, the drag on this false growth just absolutely comes down around your ears. So here we are, self-reinforcing again. You can't cut.
Yeah.
You will absolutely cripple the economy. You wait as we get into late fall and January, why the government will tell you they're not going to implement those cuts, because they won't do that to the economy. So when do you ever start to downsize the government? You'd never do.
Right. And until it implodes.
Till it breaks.
Yep. Until it breaks. And my last slide here shows that it's not just the federal debt which has been skyrocketing. This is total credit market debt owed. That's a fancy way of saying all debt in the economy, private, corporate, and government. And you can see that it's been on an incredible curve since the 1980s, the early 1980s, where the economy was financialized, and we've discussed that in previous shows. So, if it was only the federal government that was borrowing immense sums of money every year, you could say, okay, maybe the economy can survive that without disruption for a short period of time. But you can see that it's everybody in the economy's over-borrowed, over-indebted, over-leveraged. And so that makes it it compounds the problem of the federal government relying on debt. That's just a one-way street to disaster.
Charles, a healthy economy typically, if you go around the world, is at 38% consumption as a percentage of your GDP. In Europe, it's starting to climb up a little higher in the 48 range. China's down 28, 32, which has been increasing quite dramatically. We're 71 to 72% in the United States. So that tells you that we've overconsumed, and at a minimum, our run rate is way out of whack. Now, how do you bring that back? You can't bring that back without a tremendous, literally, collapse in the economy. But you can't sustain it without printing more money. And that's what keeps Bernanke up late at night grappling with that. And so he's got his solution. He's got a helicopter out there, and he's all set.
Right, but as you've covered many times, that's an end game. It's not like a sustainable solution. It's simply kicking the can down the road, and every time we kick the can, then the problem gets more severe, and the fix lasts an even shorter length of time. So
that's what's happening now. Every time we inject, the period is shorter and it takes more money. It's like a drug, and that's what we're in. Because the reason it will end, there's many reasons, but it's back to the point I mentioned before. You get the moral hazard, you get distortions, you get malinvestment and mispricing. And so what happens then is you get non-performing loans because you've had bad malinvestments. And then once the non-performing starts to cascade, It creates a death spiral going down, the same as you've had this virtuous cycle that we've had for 20 years of growth, which has been growth based on increasing leverage and gearing on our balance sheets. This is not complex. What it is just the denial that we want to take a pill and have it go away. And this is not something you take a pill to. This requires very serious surgery.
Yeah. Well said. Well, that's the end of my slides, Gordon.
Great points, Charles. The things we're also talking about, crony capitalism, financial repression, are all mechanisms that are not only supporting this movement to statism, but really the statism needs it to even exist. It can't have it. It will not sustain itself without some of these mechanisms through financial repression specifically. And financial repression, for those that aren't familiar, is forcing you to take more risks. Think of it this way. You're only getting 1% at the bank. You're probably not going to leave you can't retire on that. So you're going to have to take risk, whether you put it in the stock market or whatever. And that's what they want. They want to force that out. Into the risk curve, and that's what's coming. And there's a bunch of reasons that we can get into it on another show. Charles, when we have you back next time, we're going to be talking about central planning here later this week. But this summer we'll be off in July. But when you're back in our August show, we're really going to spend some time on financial repression and what we think the growing social unrest that's going to begin to surface as in different forms going forward. Is that what you think will happen too?
Yes, absolutely.
Charles, any points you'd like to make in closing, and could you tell our listeners how they could learn more about your website, your writing, and your recent book?
Well, thank you, Gordon. Yeah, my latest book is Resistance, Revolution, Liberation, and it's my model for a positive change, sort of resisting this one-way ratchet that we discussed today. And my website, you're welcome to visit, is of2minds.com. Thank you, Gordon.
Charles, looking forward to talking to you in a couple of days, and we'll be back and we'll talk about central planning. Talk to you then.
Okay.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.